When most people think about the stock market, they imagine charts moving up and down, technical analysis, and complicated financial reports. But behind all those numbers are people like investors, traders, and big institutions who are making decisions every second. And those decisions are not just about math. They are deeply influenced by emotions. Two emotions have been identified for centuries as the main drivers of market behavior: fear and greed. The great investor Warren Buffett summarized it simply: be fearful when others are greedy, and greedy when others are fearful. This quote captures not just investment wisdom, but also the deep psychology that underlies every bull and bear cycle in history. Economists once assumed that people in markets act rationally, always making decisions in their best financial interest. This assumption, known as the rational actor model, was central to classical economics. But reality consistently shows otherwise. Traders panic during crashes, investors chase trends, and crowds pile into bubbles. Modern psychology and behavioral economics, pioneered by figures such as Daniel Kahneman and Amos Tversky, have shown us why. Their 1979 paper on prospect theory revolutionized our understanding of decision-making under risk. They argued that humans don't weigh gains and losses equally. Losses feel far more painful than equivalent gains feel pleasurable. This imbalance gives fear a stronger grip than greed. But greed, when it takes hold collectively, can create bubbles of astonishing size. Today, we will explore how fear and greed drive markets through psychology, neuroscience, cultural patterns, and even social media. Along the way, we'll reference the academic research that explains these forces and see how they play out in history. Fear is perhaps the most powerful emotion in financial markets. The evolutionary roots of fear are deep. In nature, fear kept our ancestors alive. Detecting threats quickly and acting decisively was often the difference between survival and extinction. The same instinctive system is at work when traders face the possibility of losing money. Behavioral economics has shown that loss aversion, the tendency to fear losses more than we value gains, explains much of investor behavior. Kahneman and Tversky's work on prospect theory demonstrated that a loss of $100 hurts about twice as much as a gain of $100 feels good. This creates strong downward pressure in the stock market. When prices fall, fear multiplies. Selling leads to more selling. Investors start imagining worst-case scenarios, often far beyond the actual risks. Take the 2008 global financial crisis as an example. As the housing market collapsed and banks started to fail, fear spread rapidly. Stock markets around the world plunged. Even companies with solid balance sheets saw their values slashed, not because their fundamentals had changed overnight, but because investors were desperate to escape perceived danger. Another example is the COVID-19 crash of March 2020. Global stock markets fell more than 30% within weeks. This was not just about rational predictions of reduced profits. It was about the deep uncertainty of a new, unknown threat. The speed of the decline revealed how quickly collective fear can dominate financial decision-making. Fear also explains phenomena like flight to safety. During crises, investors rush to government bonds, gold, or even cash. It's not always logical, since holding cash during inflationary times guarantees a slow loss of value. But psychologically, it feels safer to stop the bleeding than to risk further pain. Fear manifests not only in big crashes, but also in small ways. Traders set stop-loss orders because they want to cap potential damage. Retail investors often sell at the bottom, unable to stomach further losses. Mutual fund managers may sell simply because others are selling, out of fear of underperforming their peers. The neuroscientific basis for this is clear. Fear activates the brain's alarm system, which floods the body with stress hormones like cortisol and adrenaline. This prepares us for fight or flight, but it narrows our thinking. Long-term strategy collapses into short-term survival. As neuroscientists Lowe and Repin showed in their study of traders' physiological responses, elevated stress levels correlated with poorer decision-making in volatile markets. In short, fear drives selling, panic, and retreat. It pushes investors out of risky assets and into safety. It explains why markets often take the stairs up and the elevator down. Gains accumulate slowly, but fear can erase them overnight. If fear drives markets down, greed is the emotion that pushes them up, sometimes to irrational heights. Greed is the desire not just to make money, but to make more than others, to chase opportunity, to capture wealth before it slips away. Greed, unlike fear, often disguises itself as optimism or confidence. Investors tell themselves they are simply being ambitious or opportunistic, but in groups, this ambition can spiral into collective mania. History is filled with bubbles caused by greed. The Dutch tulip mania of the 1630s is one of the earliest recorded examples. At its peak, some tulip bulbs sold for more than a house. Clearly, no rational calculation of value was driving those prices. It was pure speculation that someone else would always be willing to pay more. Fast forward to the dot-com bubble of the late 1990s. Investors poured money into internet companies with little more than a website and a promise. The Nasdaq index rose fivefold between 1995 and 2000. Stories of overnight millionaires fueled more greed. As Robert Shiller documented in his book Irrational Exuberance, the belief that this time is different spread widely, a hallmark of speculative bubbles. Greed often coexists with herding behavior. No one wants to miss out on easy gains. The fear of missing out is itself a form of greed. As prices rise, more people pile in, creating a self-reinforcing loop. Greed also shows up in risk-taking. Traders leverage heavily by borrowing to amplify gains. Retail investors chase hot stocks touted on social media. Day traders convince themselves they can beat the market because others appear to be doing it. Overconfidence, another well-documented behavioral bias, plays a key role here. Barber and Odean found that individual investors consistently trade too much, fueled by overconfidence, and underperform the market as a result. The neurological basis for greed is rooted in the dopamine reward system. When people anticipate rewards, the brain releases dopamine, creating feelings of excitement and motivation. In trading, winning activates the same pathways as addictive drugs or gambling. This is why trading can become compulsive. Each successful trade reinforces the belief that more rewards are just around the corner. In markets, greed often builds slowly, feeding on optimism, media hype, and social proof. But when it reaches a peak, it becomes unsustainable, prices detach from reality, and when the bubble bursts, greed quickly gives way to fear. Traditional economic theory, especially the efficient market hypothesis, EMH, assumed that markets reflect all available information and that prices are always rational. But behavioral finance emerged to challenge this, showing that human psychology systematically biases decision-making. Daniel Kahneman and Amos Tversky's prospect theory laid the foundation. People overweigh small probabilities, underweigh large probabilities, and treat losses much more seriously than gains. This explains why investors might buy lottery-like stocks, hoping for huge gains despite low odds, while simultaneously being overly cautious about moderate risks. Let us look at the other biases that also feed into fear and greed. Starting off is herding. This happens when investors copy others, assuming the crowd must know something they don't. Next, we have the confirmation bias. This is when people seek information that confirms their existing beliefs, ignoring contradictory evidence. Recency bias is another one in which recent events weigh more heavily than long-term trends. After a market crash, people expect further crashes. After a rally, they expect endless gains. Anchoring bias is when investors fixate on arbitrary reference points, such as the price they bought a stock at, even when irrelevant. Finally, we have the disposition effect, whereby investors hold onto losing stocks too long, hoping they'll recover, and sell winning stocks too quickly, locking in gains. Richard Thaler, in his book Misbehaving, documented how these behaviors consistently distort markets. Markets are prone to bubbles and crashes not because of rational calculation, but because of waves of collective psychology. Behavioral finance also helps explain phenomena like overreaction, panic selling, and underreaction, failing to price in bad news until it's obvious. These tendencies create momentum and reversals that traders can exploit. One particularly interesting finding is that investors are not consistent in their risk preferences. They might act risk-averse when facing gains, but risk-seeking when facing losses. This is why gamblers double down after losses, and why investors sometimes take reckless risks to get back to even. In short, behavioral finance has shown that markets are not cold, rational calculators, but ecosystems of human biases. Fear and greed are the emotional engines of these biases. While psychology explains the patterns of behavior, neuroscience shows us the machinery underneath. Neurofinance, a field at the intersection of neuroscience and economics, has studied traders' brains, and the findings are striking. A famous study by Lowe and Ripon measured the physiological responses of professional traders during periods of high volatility. They found that heart rate, blood pressure, and skin conductance all spiked during stressful market events. These physical markers of stress correlated with poor decision-making, suggesting that biology, not just strategy, drives outcomes. The brain plays a central role in fear responses. When losses loom, the brain triggers the release of cortisol, sharpening attention but also narrowing focus. This can lead to panic selling and short-term thinking. Greed, on the other hand, is driven by the brain's reward system. Anticipating gains releases dopamine, creating a feeling similar to gambling wins or drug use. This explains why traders sometimes describe markets as addictive. Interestingly, neuroscientist Brian Knutson and colleagues showed that activity in the brain predicts risky investment choices. The more excited the brain gets about potential rewards, the more likely people are to take risks, even irrational ones. Hormones also matter. Research by John Coates, a former trader turned neuroscientist, found that elevated testosterone in male traders increased risk-taking during bull markets, while high cortisol during downturns amplified fear. This creates feedback loops, greed-fueled booms followed by fear-fueled crashes. Neurofinance thus reveals why telling traders to be rational often fails. Their brains are wired for survival and reward, not for calm probability calculations. The biology of fear and greed ensures that markets will always be emotional arenas. Fear and greed are not just internal states, they are amplified and transmitted by media. Financial news outlets thrive on drama. Headlines like "Markets in Freefall" or "Stocks Soar on Optimism" stoke emotions, encouraging investors to react. In the past, newspapers and television set the tone. Today, social media has taken that role to another level. Platforms like Twitter, Reddit, and TikTok create feedback loops of hype and panic. The GameStop saga of 2021 is the most striking recent example. Posts on the Reddit forum Wall Street Bets fueled a collective buying frenzy, sending the stock up thousands of percent. Greed, in the form of FOMO and dreams of to-the-moon riches, dominated. When the stock inevitably fell, fear took over, leaving many latecomers with heavy losses. Elon Musk's tweets have also moved markets, from Tesla stock to cryptocurrencies like Dogecoin. A single word or emoji can trigger billions in market value changes. This demonstrates how collective psychology, amplified by social media, can overpower traditional financial analysis. Academic research supports this. studies have found that investor sentiment, as measured by Google searches or Twitter activity, predicts short-term market movements. The stories we tell each other can drive real financial outcomes. Media and social media don't just report on markets, they shape them by amplifying fear and greed. While fear and greed are universal, how they manifest can differ across cultures. Economic history shows that cultural attitudes toward risk, saving, and speculation shape markets. In the United States, a culture of risk-taking and individualism has fueled waves of speculation. From the roaring 1920s stock boom to the dot-com bubble to meme stocks like GameStop and AMC, Americans have often embraced speculative manias. The widespread use of 401k retirement accounts tied to markets also means a larger portion of the population is directly exposed, amplifying emotional swings. In Japan, by contrast, the bursting of the asset bubble in the early 1990s created a lost decade of stagnation. Cultural norms emphasizing caution and long-term stability contributed to risk aversion. Japanese households have historically preferred saving in cash or low-yield deposits rather than equities, reflecting a cultural memory of painful losses. In China, retail investors dominate trading. The culture of speculation is strong, and herd behavior is common. Stock markets there often swing wildly, fueled by rumors and government policy signals. The 2015 Chinese stock market bubble, where millions of new investors opened accounts, was a vivid example of collective greed followed by fear. In Europe, cultural differences are visible even between countries. German investors tend to be conservative, preferring bonds and savings accounts. In contrast, the UK has a more vibrant equity culture. These differences reflect not only culture, but also history. For instance, Germany's hyperinflation in the 1920s left a deep scar on attitudes toward money and risk. Cross-cultural studies, such as those discussed in Behavioral Economics and Finance by Barbaris and Thaler, show that while biases like loss aversion are universal, the way they play out is shaped by history, institutions, and culture. If fear and greed are so powerful, can they be managed? This is the central question for investors and traders. Psychologists and trading coaches like Brett Steenbarger and Mark Douglas, Trading in the Zone, emphasize self-awareness. Recognizing emotional triggers is the first step. Traders must learn to notice when fear is pushing them to panic sell or when greed is tempting them into reckless bets. One strategy is to rely on rules and systems. Systematic investing, whether through index funds or algorithmic trading, reduces the role of emotion. Ray Dalio, founder of Bridgewater Associates, advocates for principles-based decision-making where rules override momentary feelings. Diversification is another tool. By spreading investments, the emotional impact of any single loss is reduced. Behavioral research shows that people feel less anxious when risks are distributed. Long-term perspective also helps. History shows that markets recover from crashes. The S&P 500, despite countless downturns, has trended upward for over a century. Remembering this can temper the panic of short-term losses. Finally, mindfulness and stress management can play a role. Techniques borrowed from psychology, such as meditation or journaling, help traders regulate emotions. While this may sound soft, research has shown that emotional regulation directly improves decision-making under risk. Managing emotions doesn't eliminate fear and greed, but it can prevent them from dictating every decision. Markets are not just numbers on screens. They are mirrors reflecting the hopes and fears of millions of people. Fear and greed, rooted in human psychology and biology, drive cycles of boom and bust. Fear protects us, but it also causes panic. Greed fuels ambition, but it also creates bubbles. Behavioral finance and neuroscience show that these forces are deeply ingrained in our nature. Culture and media amplify them, shaping collective outcomes. For investors, the lesson is not to eliminate fear and greed, an impossible task, but to understand them, to see when they are at work in oneself and in the crowd. As Buffett's advice suggests, the key is to act counter-cyclically, resisting the herd, maintaining discipline, and remembering that markets are ultimately human. In the end, the psychology of markets is the psychology of humanity. The dance of fear and greed will never end because it is the dance of life itself, survival and ambition, caution and hope. The best we can do is to understand the rhythm and learn how to move with it without losing balance. As Warren Buffett reminds us, the key is not to eliminate fear or greed, but to act wisely in the face of them.